Thank you. Welcome again. Thank you for joining, I should say. And if you haven't subscribed to this channel already, please do so, because I'm giving you back-to-back lectures for you to pass your exam with ease. In our previous lecture, we talked about the statement of financial position. We talked about the accounting equation. And we said that the accounting equation is simply assets is equal to capital plus liabilities. So please keep that in mind. Please go through that video, try working through it yourself, and you should be able to work through. If you have any questions, you can drop it in the comment section of this YouTube channel. So let's take another example relating to income statements, right? So let's take another example. So this example says, on 1st June 2005, Bep DeMarco commenced trading as an ice cream salesman. Interesting. A, he rented a van at a cost of 1,000 for 3 months. Running expenses for the van averaged 300 per month. He hired a part-time helper at a cost of 100 per month. C, he borrowed 2,000 from his bank and the interest cost of the loan was 25 per month. His main business was selling ice cream from the van, but he also did some special catering, supplying ice creams for office parties. Sales to these customers were usually on credit. Very, very important. Very, very important in terms of the accrual concept. For the 3 months to 31st August 2005, his total sales were 10,000, which is cash of 8,900 and a credit of 1,100. If he purchased his ice cream from a local manufacturer, who is called Palmer Company, the cost of purchases in the 3 months to 31st August 2005 was 6,200. And at 31st August, he had sold every item of stock. He still owed 700 to Palmer Company for purchases on credit. G, one of his credit sale customers has gone bankrupt, owing Bepe $250. Bepe has decided to write off the debts in full. H, he used his own home for his office work. Telephone and postage expenses for the 3 months to 31st August were $150. During the period, he paid himself $300 per month. Prepare an income statement for the 3 months, 1st June to 31st August 2005. So that's what we're going to do. Are you ready? Are you excited? Okay, let's move on. So in an income statement, like you always need to remember, you have to have a title, right? A title, very, very important. A title. If you go to the balance sheet, it also has a title. Let me go there real quick so you can see the title for the balance sheet or the statement of financial position. Do you see? It also has a title, nicely written. It also has a title. So that's the title. The title would be the name of the company, and this would be the format of the title. It's always the same. So let's move on to the income statement real quick. So the income statement will usually start with your sales, right? So what is your sales figure? Let's go to and check. What will our sales figure be? Okay, so it says here, it's giving us clearly, it says here that just a minute, let me see. It says here that for the 3 months to 31st August, his total sales were 10,000, which is a cash of 8,900, credits of 1,100. Remember, the accrual concept allows credit transactions. So we take the full 10,000 and we record it. So you see that in the solution. If you go to the solution, you should see the 10,000 here. You should see the 10,000. That's the 10,000 for you right here. right here. Then you move on to cost of sales. Cost of sales. Cost of sales. Okay, so when we talk about cost of sales, right? Let's look at what cost of sales is. Cost of sales, the cost you incur to sell. The cost you incur to sell. So what will be our cost of sales? Let's go to the question to find out the cost of sales. Let's go to the question and find out what our cost of sales will be. So the cost of sales would be, the cost of sales is given in the question. It says he purchased an F, right? He purchased his ice cream from a local manufacturer, Palmer Company. The cost of these purchases, that's the cost of sales. The cost of purchases in the 3 months was 6,200. Right here. Right here. So you have your cost of sales or cost of purchases. Fantastic. So we go here and record it nicely in our income statement. So it's very, very simple. Very, very simple. So that's our cost of sales. It's 6,200, like we found out. Then if we take out our cost of sales from our sales, we get our gross profit. Our gross profit, which is 3,800. 3,800. Now, we need to come and take out our expenses. Our expenses. So let's go and find some expenses and see how that feeds into everything. Let's go and find out some expenses. So if you go to here, there are lots of expenses, right? There are lots of expenses. Let's start at the top. Let's start at the top and see what kind of expenses that we have. So if you go to the top, let's go to the top. Let's scroll to the top and see our expenses. So he rented a van at a cost of 1,000 for 3 months. Remember, we are preparing this for 3 months. So that's our first, expense. That's our first expense. That will be our first expense. So if you go, let's go and check our solution to see if it's there. Let's go and check our solution. Yes, it's here. It's here. So you see, the van rental is 1,000. The van rental is 1,000. Very, very important. The van rental is 1,000. Then let's go back to our question again. Let's go back to the question again. So I went too far. Let's go back to the question again. If you go back to the question, it says running expenses for the so the first expense we got was the van rental. Now we are moving on to the running expenses for the van, average 300 per month. So if it's 300 per month, you are preparing this for 3 months. So 300 times 3 should give us 900. Should give us 900. Should give us 900. Yes. It should give us 900. So basically that's it. It should give us 900. So 300 times 3 equals 900. I hope it's clear. It should give us 900. Okay. So I hope it's making a lot of sense now. It's making a lot of sense. Okay, so let's move back. Let's go and find. So that's the second expense we found. So you found 1,000, you found 900. Then now he hired a part-time helper. A part-time helper. So let's look into this one a little bit. A part-time helper at a cost of 100. So let's go back to the solution. You should see the part-time helper right here. Right here. Part-time helper. Part-time helper. Part-time helper. should see part-time helper. Let's go back to the question again. Let's go back to the question again. And let's go back to the question and check again. The value. We want to know the value of the part-time helper. So let's go back to the question. Let's go back to the question. Let's go back to the question. The part-time helper is how much? 100. 100. Okay, it was 100 per month. 100 per month. That's what the question is saying. So that's represented by the wages. So you see 3 times 100. 3 times 100, which gives you how much? 300. Which gives you 300. So we found that one too as well. We are making progress. We found 3 expenses. So let me just state here that the wages here is the part-time helper. Part-time helper. Part-time helper. It might be something you would want to know. So part-time helper. Part-time helper. Okay. Then let's move on to other expenses. It's getting fun. Let's move on to other expenses. Let's go back to the question and see. What will be some other expenses? Other expenses. Let's go back and see. Another expense we can also find if we go through this. We go through this. He borrowed 2,000 from his bank. So the 2,000 is a loan, but that will go into what? The balance sheet or the statement of financial position. The interest costs of the loan, which is $25, will go into the income statement. But this $25 is 25 per month. It's 25 per month. So let's see, 25 per month. So 25 times 3 will give us how much? 75. 75. So you go back to the question and you see that you should see this. You should see this right here. See? You should see this. You should see this right here. Let me clear these drawings. You should see this right here. Interest charge is how much? 75. 75. So you see, it's becoming clearer and clearer. Then let's move on to the next one. The next one. Let's see if we can find some more expenses. Let's see if you can find some more expenses. So you go here, it says what? His main business was, okay, there's really no information in that. If you go to G, it says one of his credit sale customers has gone bankrupt, owing Beppe $250. $250. He has decided to write off this debt. So bad debt written off. If you write off a bad debt, it's as an expense. It's an expense. It's an expense. So very, very important. So you have $250. Then let's see if you can find another expense, because it looks like we are wrapping up. You have $150. Telephone and postage expenses, $150. Telephone and postage expense. So those are the 2 expenses that we have now. So if you go back, you should see 250 and 150 there. $250 and $150. I hope you can see it. See, that's right here. See, bad debt written off telephone. So $250 and what? $150. Nice. So someone might ask, did we use all the information? No, we didn't use all the information for the income statement. There's one thing that there's something we ignored, which is I. remember, during the period, he paid, which is referring to the owner, paid himself 300 per month. Yeah, paid himself 300 per month. So these are drawings. These are drawings. These are drawings. And that's what we talked about when we are looking at the balance sheet. These are drawings. And drawings go into the capital section. Capital section of the statement of financial position. Very, very important. Very, very important. I need you to remember that, please. I need you to remember that so that you don't miss that. So you see how simple this whole thing can be. I hope you can see how simple this whole thing can be. So if you even look here, it says the amount of 300 per month that BP paid to himself are drawings and will be taken to the capital section. So you see, you have your sales minus your cost of sales, you get a gross profit of 3,800 or 3,800. Then you have all these expenses adding up to 2,675. You deduct your expenses from your gross profits and you get a net profit of how much? 1,125. 1,125. So that becomes your net profit for your income statement. Very, very simple. Very, very simple. Very, very simple. Then let's move on to other issues. I said we'll talk about capital and revenue, expenditure and income, capital expenditure, revenue expenditure, capital income, revenue income. So when we say capital expenditure, what do we mean? When we say capital expenditure, what do we mean? Capital expenditure is expenditure which results from the acquisition or improvement of a non-current asset. So for example, when you buy a building, it's capital expenditure, or you can call it CAPEX or CAPEX for short. When you buy a building, it's capital expenditure. It's capital expenditure. Very, very important. And revenue expenditure is expenditure which is incurred for the purpose of trade, for the purpose of trade or to maintain the existing earning capacity of non-current assets. Remember, capital expenditure is to what? Acquire and improve non-current assets. Revenue expenditure is for the purpose of trade and normal business operations, or to maintain, not to improve, to maintain the earning capacity of non-current assets. So revenue expenditure, you have examples like salaries and wages, utilities, rents, revenue expenditure. And let's move on to capital income versus revenue income. Capital income is simply the proceeds you get from selling non-current assets. The proceeds you get from selling non-current assets. Very, very important. The proceeds you get when you sell non-current assets, there are some proceeds you get, right? There's some proceeds you get. So the proceeds you get from selling non-current assets is called capital income. Revenue income, however, is the proceeds you get from your normal trading assets. When you sell normal goods and services, that's revenue, you get revenue income. So revenue income comes from the following sources: sale of trading assets, interest and dividends from investments held by the business. So anytime you hear the word capital, your mind should go where? To non-current assets. Should go to non-current assets. That's very crucial. Very crucial. Very crucial. So let's look at a question. I always say that questions bring to life the theory. Questions always bring to life the theory. So let's look at the question, right? I just want you to understand this through a question. That would help you. So let's classify each of the following items as capital or revenue expenditure. So we'll take it step by step. Number one, purchase of leasehold premises. What is a leasehold premises? A non-current asset, right? So it will be what? It will be if you purchase a leasehold premises, it will be what? A capital expenditure. Let's go check our solution to see if you're right. You see, A is capital expenditure. A is capital expenditure. That's it right down there. A is capital expenditure. Where I'm hovering my mouse. A is capital expenditure. Okay. The annual depreciation of leasehold premises. Always remember that depreciation is what? Revenue expenditure. Revenue expenditure is coming out from normal business operations. Normal business operations. So it's revenue expenditure. Revenue expenditure. So you go back to see depreciation of a non-current asset is revenue expenditure right here. It's very clear. Very clear. So always keep that in mind. Always keep that in mind. Then solicitors' fees in connection with the purchase of leasehold premises. If you have solicitors' fees that are connected, solicitors' fees in connection with the purchase of leasehold premises. You know, the key word there is in connection with the purchase of leasehold premises. So it's part of the leasehold premises package. And therefore, since it's, you know, it's a part of it, it will be a capital expenditure. It will be a capital expenditure. So let's go and check. Yes, so since these are legal fees, right? These are solicitors' fees, and they come with the purchase of the property, you can add them. You can add them to the purchase price, you know, as capital expenditure. Remember, we define capital expenditure as acquiring, you know, non-current assets. So the legal fees that are part of acquiring the non-current assets, you can add it to capital expenditure. You can add it to capital expenditure. Then you move on to D, the cost of adding extra storage capacity to a mainframe computer. What are you doing here? You are improving a non-current asset. So it will be a what? A capital expenditure. If you come here, you should see a capital expenditure. Capital expenditure. You are enhancing an existing non-current asset. Computer repairs and maintenance costs. Computer repairs, you know, anything that is operational in nature, or you do it to maintain the earning capacity, not improve, maintaining the earning capacity of a non-current asset will be revenue expenditure. So this will be revenue expenditure. So let's go check and see if it's actually revenue. It was F. So let's see. Revenue expenditure. It was E, sorry. It was E. Let's just be certain. Yes, it was E. So E is what? Revenue expenditure. Yes, E is revenue expenditure. Then let's move on to F, profits on the sale of an office building. When you gain income from a non-current asset, was that capital income? Capital income. So this would be capital income. Let's go check, see whether what we are saying is actually true. Capital income, F. You see? F. Let's move on to G, revenue from sales by credit card. You know, if you gain income from normal sales operation or trading operations, then that's what's revenue income. That becomes revenue income. So that was G, revenue income, which you can also call trading income. Trading income. Then you have H, the cost of a new machinery. What would that be? That would be capital expenditure. Capital expenditure. So let's see. Capital expenditure. You see it's right here. It's right here. Then I, custom duty charged on the machinery when imported into the country. You know, so in this case, this custom duty is a part of the machinery cost. It's a part of the machinery cost. Without the custom duty, you can't even import the machinery. So custom duty will be added to the cost of the machinery as a capital expenditure. So I is capital expenditure. You know, any cost you incur in acquiring the assets, that makes the acquisition of the assets possible, like custom duties, like legal fees, you add it to the cost of the non-current assets, and it's a capital expenditure. So you see, says I, if customs duties are borne by the purchase of the non-current assets, they may be added to the cost of machinery and classified as capital expenditure. As capital expenditure. So if the one who is buying is borne, if the cost is borne by the purchaser, to be classified as what? Capital expenditure. The carriage cost of transporting the new machinery from supplier's factory to the premises of the business purchasing the machinery. This is also a capital expenditure. If the carriage cost is going to be borne by the purchaser, because if you need to carry the machinery from one place to another, it's part of the cost, the entire cost of the machinery, of the new machinery. So it will be a capital expenditure. Remember, it's all the total cost of acquiring a non-current assets. So let's see. Similarly, if carriage costs are paid for by the purchase of the non-current assets, they may be included in the cost of the non-current assets and classified as well capital expenditure. So it's quite clear. It's quite clear. It's quite clear. Let's move on to the next one. K, the cost of installing the new machinery in the premises. This is also a capital expenditure. Installation costs. If you are installing a non-current asset, it's also part of the cost. It's also part of the total cost of acquisition. So things like installation cost, legal fees, carriage cost, custom duty cost, all those things would go in as capital expenditure, because it's all the cost you are incurring to acquire a non-current asset. Then the wages of machine operators will be what? Revenue expenditure, because these are coming out from the normal day-to-day operations. So that's what you have here, revenue expenditure. So basically, I hope you got the difference. Let me go through the difference again. So capital expenditure is expenditure which results in the acquisition of non-current assets. So cost you incur, the total cost of acquiring a non-current assets, so it's inclusive of legal fees, it's inclusive of custom duties, it's inclusive of carriage costs, it's inclusive of installation costs, or anything you incur to improve the earning capacity of a non-current asset. The revenue expenditure is expenditure which is incurred for the purpose of trade or to maintain the earning capacity of non-current assets, not to improve, but to maintain. Then you have capital income, which is the proceeds we receive from the sale of non-current assets. Then you have revenue income, which is you get from selling or trading assets, and any interest and dividends you receive from investments. So that's the difference. I hope that was helpful. So that will be the end of this class. I hope you enjoyed it. If you haven't subscribed to this channel, please do so. Please do so. I'll be posting a lot more lectures for you, and you should be able to understand the basics of accounting, and you pass your exam with these. Thank you, and enjoy your day.